In early June 2026, during his Computex keynote, NVIDIA CEO Jensen Huang publicly endorsed Marvell Technology, calling them the next trillion-dollar company. Following that keynote, Marvell experienced a massive rally, adding $62 billion in market cap and capping a 250% year-to-date run to $254 billion. This solidified Marvell as the primary infrastructure supplier of the AI build-out, a status cemented earlier by NVIDIA's $2 billion direct investment. But this rapid price appreciation presents an immediate problem for investors, reconciling a euphoric valuation with the gritty reality of Marvell's financial mechanics and complex multi-billion-dollar acquisitions. To determine if the company can support a $250 price tag, we have to evaluate Marvell across 4 specific dimensions: its hardware moat, its financial quality, the trading behavior of its insiders, and its competitive mechanics against industry giants. Understanding Marvell requires looking past the NVIDIA halo effect and directly examining the physical and financial bottlenecks it is actively attempting to monopolize. Physical constraints on AI scaling are migrating. As models grow, the bottleneck moves from the individual chip to the data center cluster as a whole. Marvell sells directly into this structural bottleneck through 2 massive data center growth engines: custom AI compute silicon and high-speed electro-optics. On the compute side, Marvell co-designs specialized accelerators directly with hyperscalers. This includes widely reported engagements on Amazon's Trainium architecture, Microsoft's Maya program, and ongoing development for Google's custom TPUs. On the optics side, they produce high-speed PAM4 digital signal processors and 1.6T transceiver modules. A product line management expects to reach a $1 billion annualized run rate by fiscal 2028. As AI clusters expand across entire facilities, traditional copper wiring completely exhausts its available bandwidth and power budget. The solution requires a scale-up photonic fabric, using light to transmit data directly between server racks. This 3D wireframe illustrates that transition. To capture the junction where copper switches to optical pathways, Marvell acquired Celestial AI and XConn. Securing these compute, switching, and optical junction points creates multi-generational switching costs, locking Marvell's IP into the customer's long-term roadmap. By assembling these assets, Marvell has positioned itself as the only merchant supplier capable of spanning custom compute processors, copper interconnect wiring, pluggable optical modules, and scale-up photonic fabric under one roof. Through targeted engineering and aggressive acquisitions, Marvell has established a footprint across every major interconnect choke point. This hardware positioning translates directly to the top line. Marvell closed fiscal 2026 with a record $8.195 billion in revenue, up 42% year-over-year. Management expects this momentum to accelerate, guiding for approximately $16.5 billion in total revenue by fiscal 2028, driven by a 55% compound expansion in their data center division. Yet, beneath these revenue figures lies the primary point of tension for financial analysts: a massive, persistent gap between the company's reported GAAP and non-GAAP profitability. This chart visualizes the severity of that split. While non-GAAP net income reached $718 million, GAAP net income was a mere $34.5 million. The waterfall breakdown explains the drag, stripping out acquisition integration charges, amortization, and massive stock-based compensation. Despite the thin GAAP margins, cash generation remains highly robust. The company generated a record $638.8 million in first quarter operating cash flow, fortifying a $3.84 billion cash pile that comfortably services their existing debt. The primary balance sheet risk lies instead in $13.9 billion of bloated goodwill generated by their serial acquisition strategy, an accounting premium that carries severe impairment risk if AI hardware demand slows down. That demand profile is exceptionally concentrated. Data center sales now make up 76% of Marvell's total business, driven almost entirely by the capital expenditure budgets of just a handful of hyperscalers. While liquidity is secure, the heavy M&A footprint, lack of GAAP profitability, and extreme customer concentration leave Marvell highly vulnerable to any sudden contraction in hyperscaler spending. Marvell's current valuation was largely forged in a highly concentrated 180-day window between December 2025 and June 2026. This timeline maps the sequence of catalysts, beginning with the Celestial AI acquisition, accelerating sharply with NVIDIA's $2 billion investment, and peaking with Jensen Huang's endorsement. Wall Street aggressively chased the momentum, with major banks rushing to issue upgrades. Retail euphoria quickly followed, with speculation regarding an S&P 500 inclusion, driving Marvell to an extremely bullish 96 out of 100 sentiment score on retail trading platforms. But the trading behavior of Marvell's own executive team during this exact same window tells a distinctly different story. Filings reveal 11 separate open market sales by corporate insiders, including significant dispositions by the CEO and the data center group president, and 0 open market purchases. These sales were executed under pre-scheduled trading plans and do not represent executive panic. However, the complete absence of executive buying at these price levels serves as a measurable caution flag regarding the stock's near-term ceiling. Furthermore, investors cannot rely on direct federal subsidies to pad the balance sheet. As a fabless designer, Marvell's government footprint is limited mostly to its defense subsidiary, bypassing the massive CHIPS Act manufacturing grants awarded to physical foundries. The stock is currently riding a wave of flawless market sentiment, creating a highly asymmetric setup, where underlying business performance must execute perfectly just to avoid multiple compression. To understand the difficulty of that perfect execution, we have to map Marvell against its primary rival and the sector's reigning Goliath, Broadcom. This matrix plots the competitive landscape. Marvell and Broadcom sit isolated in the top right duopoly, which hyperscalers actively exploit to preserve negotiating leverage. This contrasts sharply with smaller, narrow niche connectivity specialists like Astera Labs and Credo in the bottom right. Marvell's strategic counter to Broadcom's massive scale has been to outpartner them. By embedding its custom chips and optics directly into NVIDIA's NVLink Fusion ecosystem, Marvell successfully converted the dominant AI platform vendor into a dedicated sales channel. Yet corporate competition is secondary to the physical realities of global manufacturing. Because Marvell is a fabless designer, it relies entirely on external foundries, predominantly Taiwan Semiconductor, to physically manufacture its leading-edge 3nm and 2nm silicon. This single point of failure exposes the entire hardware stack to severe geopolitical risks, from escalating tensions in the Taiwan Strait to volatile U.S. tariff policies under ongoing Section 232 investigations. While aggressive acquisitions and the NVIDIA partnership have effectively secured Marvell's position against Broadcom, its heavy reliance on offshore fabrication and hyperscaler budgets leaves it exposed to macroeconomic shocks far outside its direct control. This brings us back to the central question: does Marvell's physical reality justify a $250 billion valuation? The structural bull case is mathematically intact. Marvell's engineering roadmap precisely anticipates the industry's irreversible shift toward custom data center accelerators and cluster-scale optical interconnects. Conversely, the fundamental bear case centers entirely on execution, successfully integrating over $5 billion in recent acquisitions, managing massive accounting adjustments, and surviving intense customer concentration. Returning to the dossier dashboard, the synthesized data reveals the scale of their ambition. If management hits their fiscal 2028 targets, Marvell will have successfully quadrupled its total revenue in exactly 4 years. At this scale, the primary risk for investors is the sheer gravity of expectations permanently embedded in the stock price. Marvell sits exactly at the physical choke points of modern AI infrastructure, but at a valuation priced for absolute perfection, the company has left itself zero margin for operational error.